So this evening, we are going to be looking at a very important accounting standard, which is very crucial for financial reporting and also corporate reporting. You can see a question as a footnote on this particular standard in consolidation and also a standard on its own. It can be part of the financial reporting standards and corporate reporting. You might be seeing a question on impairment of assets and financial reporting. Last sitting, you have seen a question on that, but you can still see a question on that part or this particular standard. So we are going to try everything possible to make it very simple and understanding, and pick some tutorial questions and see how we can go about them. Okay, so yeah, let's take this particular one. Assuming you bought a car, and so let's say you bought a car at 20,000 Ghana cedis. Okay, initially you were thinking that this particular car you'll be using it to cover okay, let's say you are thinking that the speed will be I'm not engineering student, so I cannot actually predict. So let's say the speed you are thinking that the speed is now, let's say the speed should be like, it should be able to cover a distance of 100 kilogram maybe for a day, or maybe the maximum distance that can be covered is 100. The 100 kilometer is too small. So let's say if you want to use it, if you put everything together, let's say it is 1,000 kilometers for a year. So the car will be used for 1,000 kilometers, or you cover 1,000 kilometers maximum every day for maybe 5 years. Maybe the useful life of the car is 5 years. Okay. Now government has now passed a legislation. That is going to be restrict, or that is going to restrict what the distance that the car should cover every day. Okay, the distance that the car should cover every day. The question now is, if we are covering this one, let's say this is a year. Okay, let's say this is a year. This will cover 1,000 kilometers every year. What will be the cost per kilometer? What will be the cost per kilometer over the 5 years? What will be the cost per kilometer? Every year you should be covering 1,000 kilometers. So for the whole 5 years, you are going to be covering 5,000 kilometers. So what will be the cost per kilometer? Let's do that. What will be the cost per kilometer over the 5 years? What are we getting? What are we getting? Are we together?
Yes, please.
So what are we getting? You purchase a car for 20,000 kilometers, and the maximum distance that you can cover in a year is 1,000 kilometers, and you are going to use the car for 5 years. So what will be the cost per kilometer for the 5 years? What will be the cost per kilometer for every kilometer that you are going to be covering? What will be the cost? Are you sure?
5,000.
5,000.
No, you are covering 1,000 kilometers every year. So over the 5 years, that will be 5,000 kilometers.
That will be 40.
Is it 40 or 4?
4. It's 4. It's 4.
It's 4.
That will be 4.
Okay. So the cost per kilometer will be 4 over the 5 years. So that will give us 5,000 kilometers. Okay. So this is what you are going to be. This is the benefit that you are going to be. You're saying that every kilometer that you are going to cover, you are going to have, or you are going to spend 4 cedi per kilometer. That is the benefit. Okay. Now the government has passed a legislation that is limiting the kilometer that you should cover, or the distance that you should cover every year, to 750. Okay, let me see. The government is passing a legislation to restrict it to 800 kilograms. Okay, so the government has now passed a legislation. The value of the car will still be will still be the 20,000. Okay. The value of the car will still be the 20,000. But the government has now passed a legislation that is going to restrict the 1,000 kilogram to what? 1,000 kilogram to 800 what? Kilograms every year. That is going to restrict the 1,000 kilogram to what? 800 kilograms every year. So you can see that the total will now be 4,000 kilograms. Okay. The total will now be 4,000 kilograms. The question now is the 20,000 is actually for 5,000 kilograms. That is the what? That is the actual distance that the car should cover. Now the government has now passed a legislation to restrict the what? The distance that should be covered every year to what? 800 kilograms. And that is going to be for 5 years. And you are going to be having 4,000. Okay. The question now is which value of the car that you are going to be using to cover, because we know that 20,000 is for 5,000 a year. Okay. If 20,000 is for 5,000 a year, then 4,000 will be how much? The 4,000 will be how much? Let's calculate that one. 4,000 will be how much? If 8,000 is
It's 5.
5,000.
It's 5.
No, we are not calculating that. This is
That'll be 5.
this is a small proportion. Okay. If 20,000 is equal to 5,000 kilograms, what would be 4,000 kilograms? We know that the 20,000 is based on what? 5,000 kilograms. That is the what? That is the maximum distance that we have to cover. But we are able to cover only 4,000. What would be the portion of the cost that would be for the 4,000?
Okay.
So if 20,000 is equal to 5,000, 4,000 will be equal to how much? Would that be 16,000?
1,000.
That would be 16,000, isn't it? Okay.
Yes,
So
sir.
the meaning is that you are
Oh.
saying that you are going
Yeah,
to
don't
use the
touch
car
my
for
pussy.
5,000.
Don't come.
You are going to use a car for 5,000 kilograms. Okay. The benefit that you are going to be getting for the 5 years is 5,000 kilograms. Government has now passed a legislation to restrict the kilogram to 4,000 now. The question is, if 20,000 is 5,000 kilograms, how much will be the 4,000 kilograms? Okay, so the benefit that you'll be getting from using the car for 4,000 kilograms will now be 16,000. You can see that the benefit is reducing. Okay, the benefit is reducing by 4,000. It means that the value of the asset has reduced by 4,000, and that is what we call the impairment. So after purchasing the asset, what is the associated benefit with the asset? Okay, now the condition is no longer there. Maybe something has happened and the benefit is now going to be reducing. The question is, what proportion of the asset will be giving you that benefit? 20,000 for 5,000. That is the maximum benefit. Now, the government is now saying that we can only cover 4,000 kilograms. What portion of the assets that is going to be given us the 4,000? It is now 6,000. You can see that the cost has now reduced to the 6,000. It first, the benefit was 20,000. Now, it is now what? 16,000. Or the value of the benefit was 20,000. Now it's 16,000. This has reduced by 4,000. What is causing it? It is the regulation that has been passed by the government that caused this particular benefit to reduce from 20,000 to 16,000. And the difference over there is what we are calling the impairment. So what is the idea for the impairment? Impairment is you purchase an asset. You are saying that the asset is going to help you produce 5,000. So you purchase machine. You purchase a machine, let's say for 15,000. And you are saying that this machine will help you to produce 5,000 units every year. Okay. Government or the machine that is now the machine has broken down, or government has passed a legislation that is going to restrict the production of the unit to what? To 4,000 units. The question is, we are saying that the 15,000 will help us to produce 5,000. Now, if we are producing 4,000, it means that we can't use 50,000 to produce 4,000. What portion of the asset will be used to what? Will be used to produce the 4,000? That is what we are looking for. You can see that there will be a reduction in the benefit. As far as there is a reduction in the benefit, we have to look for the corresponding value of the asset that will give us that particular benefit. So if 15,000 is for 5,000, how much will be for 4,000? There will be a reduction in the value of the asset that is going to be giving us what? The 4,000 benefit. The difference between the original and the new one is what we call the impairment. So as far as the benefits is reducing, the value of the asset will also be reducing. So we are keeping the asset at 15,000, which the benefit is 5,000. Now the government is saying that we can produce what? 4,000. We cannot keep the asset at 15,000 again because the 15,000 is for 5,000. Now 4,000, what value should be used to produce the 4,000? What would be the benefit? What would be the value of the benefit that will give us the 4,000? That is what we want to. We want to bring the asset back to its benefit level. And that's what we call the recoverable amounts. And the difference between the asset and this, you can see that we are going to be losing 1,000 of the benefit. This 1,000 of the benefit, what value of the asset we are losing, that represents what we call the impairment. So the impairment is possible or is necessary when the benefit or the expected benefit of the asset is no longer going to be the same. Mostly there will be a reduction in the benefits. So if there's a reduction in the benefits, the value for the same, the cost relating to the benefit first will now be lower than the cost relating to the new benefit. And the difference between those values is what we call the impairment. Okay, so we are going to be looking at, so this is just the idea about the impairment. You purchase a car for 15,000 and you are saying that you are going to use the car for 5 years. The car has now involved in accidents and you are going to be using it for what? For 4 years. Okay, I want to use 20,000 worth of cars for 5 years. Now I want to use for 4 years. You can see that the benefit that the car will be giving to you will no longer be the 20,000. You are going to be using a 1 year benefit there. That 1 year benefit, what we call the impairment. It is bringing a reduction in the value of the asset. Okay, that is what we call impairment. So we are going to be looking at IAS 36, which is impairment of assets, and we look at some basic issues and we move on. So we look at what we call the 36, which is impairment of assets. What you have to know is that mostly people will be telling you that it's only non-current assets that impair. Please, it's a lie. Okay, people will tell you that it's only non-current assets. That is actually a lie. Okay, only a non-current asset that impair. Okay, that is actually a lie. Why? Because in the exam condition, the question will be telling you that the net realizable value of the net asset or of the other net assets are the representative of the recoverable amount. The assumption is that those value of the receivables, payables, and also the inventories are the same as the recoverable amount. So there is no impairment on them. Okay, but you see what you have been doing, that you should write the inventory to the lower of cost or each net realizable value. The difference over there, which is the loss, is an impairment of the inventory. What is causing the reduction? Because the market value of the inventory has declined. The inventory is now obsolete. So you can see that the value of the inventory is not just reducing, it's reducing because of a condition. And that condition is an indicator of impairment. So if you are a software organization, you are selling softwares. Okay, now there is a new software. It means that the old software will no longer be what? Will no longer be marketable. And the market value will be reducing. Therefore, the cost of the asset will be higher than the net realizable value because people will not be demanding for that particular software again. What is bringing the selling price lower than the cost? Because of the invention of the new software. And that is an indicator of impairment. So the loss that we have been writing on the inventory, which is the lower of cost and net, that is technically an impairment loss. That is technically impairment loss because the inventory will no longer, the value of the inventory will not just reduce, it will reduce because of a condition. If you count to receivables, the provision for doubtful debt that we have been making on receivables is an impairment. Why do we make provision? Because there is a possibility that portion of the people will not be paying. Why? Because a customer has now gone into liquidation and there's a possibility that 5% will not pay. You are not just making a provision on the what? On the receivables. You are making it because of a condition. And that condition is an indicator of the receivables impairing. So bad debts and also all those provisions are technically impairment to the receivables. If you count to cash, mostly people will say, how will cash impair? The value of money is measured in the quantity of goods that the money can purchase. So if you can purchase 20,000 bags of cement with 10,000, in the next few months, you cannot purchase the same thing. It means that the value of the cash has reduced. That is technically what we call impairment. So in the exam condition, they will be saying that the current assets, their value are still the same. It doesn't mean that current asset does not impair. The reduction or the lower of the cost, the difference between the inventory, that you call the loss, is an impairment to the inventory. The provision for doubtful debt on the receivables is an impairment to what? To the receivables. Okay, but just that the cash, you cannot recognize the what? The impairment on the cash. Okay, but in technical terms, cash also impairs. Why? The value can buy 20,000 worth of cement. Now it can buy only 1,900. The value of cash has reduced. That's why they say that our currency has been what? Has been depreciating. Our currency has been impairing. That is the meaning. Our currency has been depreciating. The fall in the value, it means that currency has impaired. Depreciation, how do we calculate the depreciation on the currency? It's just a term that they are using for the currency. The currency has impaired. Okay, so, but this one, our focus will be on a non-current asset. All right, you have to know that the IAS 36 is basically being issued for asset carry under cost model. Okay, I will explain this one. Basically, they are carried and they are issued. The IAS 36 applies to the asset carry under cost model, or this particular standard is being developed for asset carry under cost model. Why? If you take asset carry under revaluation model, you see that at the end of every year, you revalue the what? The asset. Any loss, any reduction in value will be accounted for. So it means that asset carry under revaluation model, basically we do impairment on them, because at the end of every year, we look for the fair value. At the end of every year, we look for the fair value. At the end of every year, we look for the market value. Any difference over there, which we call the revaluation loss, will be what? Will be written off. Okay, so all the provisions that we are going to be looking at under the IAS 36 is basically applicable to what? To asset carry under cost model. If we count to asset carry under revaluation model, the treatment of the impairment loss is treated like how we treat what? Revaluation gain and what? Loss under IAS 16 for asset carry under revaluation model. Okay. When do you carry out impairment loss? Okay, when do you carry out impairment test? When do you carry out an impairment what? When do you carry out an impairment test on assets? Okay, although we have certain assets that it is compulsory for you to carry out impairment test, but when do you carry out an impairment test on assets? When there is an indicator of what? Impairment on that particular asset. So when an indication, okay, when an indication or indications, it can be any of them, when an indication of possible impairment of the assets exists, okay, at the reporting date. So what will happen is that, okay, is there something that is going to be telling you that the expected economic benefit of the asset will now be lower than its cost, or the expected benefit that is not going to be the same as the actual benefit? So there can be a government legislation. Government can now pass legislation that we can no longer produce up to a maximum capacity. So if the machine we want to produce up to a maximum capacity of 10,000, that's the benefit that the machine will be giving to us. Now the government is saying that 8,000. What value of the asset will be helping us to produce the 8,000? We cannot say that we want to produce 10,000 and the same value in terms of benefit, the same value will be giving us 8,000. No. So what value will be giving us the 8,000? Then we look for that one and look for the difference. So those assets we have assets that you have to carry out an important, like it is necessary that you have to carry out impairment tests on them at the end of every reporting period. But those assets that are not part of this group of assets, we only carry out impairment tests on them when there is an indication of possible impairments. So the indication can be external or internal. The points are there. Okay, the external can be, there is now a technology what changes, like software. You are selling a software, now there is an invention of a new software. The new software will now make the old software obsolete. it will make it not to be what effective or not to be marketable in the market again. When there is an issue of economic situations, when we are using inflation rates, okay, there's a fall in demand for our product. There's a government legislation. There's an increase in interest rate. Why do we say interest rate? Because if we are calculating the value in use, we use the interest rate. So the lower interest rate will give us the highest cash flow. If the interest rate is increasing now, you have to know that your cash flows that you are going to be calculating, your discounting will be very low now. So increase in interest rate can also be an indicator. You count to the internal one. Maybe the asset is now physically damaged. Okay, the asset is now physically damaged, or the entity is saying that the value of the asset or the carrying value of the asset is higher than the market value. So they might ask you this once is part of the note there. You have to calculate for that. Okay. Let's look at the group of assets that you have to do compulsory impairment test on them before we move on. Okay, I don't want to use the notes, so let's try to make it very simple and see. Compulsory impairment. So what are those category of assets that you have to carry out in compulsory impairment test on? We have intangible assets with indefinite useful life. Okay, intangible assets with indefinite useful life. Okay, intangible assets with indefinite useful life. Okay, intangible assets with indefinite useful life. Let me, why the useful? Okay, indefinite useful life. So another intangible asset, we have certain assets that they will say we are going to be using them into the foreseeable future. So those assets at the end of every year, you have to carry out impairment tests on them. It's compulsory. Okay. We also have the intangible assets that are not yet ready for use. Okay. Intangible assets not yet available for use. Okay. Not yet ready for use or whatever. You can have issue with what? The company is developing a software now, so the software is not ready. So at the end of every year, you check to see whether the cost and the carrying value and then the recoverable value. If you should sell the software now, or if you continue using the software, what is the value? So at the end of every year, you check and see whether there's any issue with that. We also look at goodwill acquired in business combination. Okay, goodwill acquired in business combination. So if you count the business combination, mostly the investor is going to acquire the net asset of what, or the equity shares of the subsidiary. And this is going to be sometimes, this can be acquired at a premium. Okay, the net asset can be 20,000 and we'll be paying 22,000. We are paying a premium. That particular premium, we might be paying it for the location of the entity or its relationship with the customers, or maybe the kind of workforce that they have, which we call the goodwill. So at the end of every year, we check to see whether the location is still, what we are paying for is still relevant. The location is still relevant. The workers are still there. The relationship is still there. So we check we do an compulsory impairment test on these three categories of assets. Goodwill acquired in business combination, intangible asset not yet available for use, intangible asset with indefinite useful life. They can ask you as a theory question. Okay, let's come here. When you determine that there is a possible indication of an impairment, okay, there's an indicator or there's a condition that is likely to tell us that the asset is going to be impaired. What do you have to do? What do you have to do? You have the value in your books. Okay, you are always going to be having the value of the asset in your books. So you look for the carrying value of the asset. That is the value of the asset in your books. Okay, now you ask yourself, okay, now the benefit I'm going to be getting from the asset is going to be lower than what? Lower than the recoverable, lower than the amount that I'm representing the asset. I'm representing the asset for this particular benefit. Now the benefit has reduced as a result of this. So what should have been the benefit now? Okay, how much should have been recovered from either selling the asset or continue using the asset? So what would be the value of the benefit now? The new benefit, what would be the value? And that particular one we call what? The recoverable amount. So if you have a car that is going to be for, if you have a car that is going to be for 5 years, government is now saying that you can only use this car for 4 years. Okay, it means that you are going to be losing. You can decide to sell the car now, or you can decide to continue using it. So the question is, if you want to sell it now, how much are you going to get from it? If you want to sell it now, how much are you going to be recovering from it? If you sell it now, how much are you going to be getting? Okay, or if you want to continue using it, what is the benefit? What is the expected benefit that this particular asset will be giving to you? Okay, then you compare your carrying value with the benefit. So the benefit, if there's an indication of impairment, we need to do two things. Okay, we find the carrying value of the asset, which will always be in the books of the company. Now you ask yourself, now the benefits are reduced. So what is the value that I'll be getting from the new benefit now? You can decide to sell the asset, or you can decide to continue using it. So you look for what we call the recoverable amount, which is the value of the benefit that you'll be getting as a result of the changes in the assets. Okay, this recoverable amount is, we have two. So we have the two issue. The recoverable can be done through a continual use, whether you want to continue using the assets. Okay, you want to continue using the assets. So if you want to continue using the asset, what is the expected benefit that the asset will be giving to you over the remaining useful life? You are looking for today's value, so you present value those ones. So the recoverable amount is the higher of either what we call the net realizable value. That is, if you want to sell the asset now, if you don't want any problem, you don't know what the government will come up and say again. So I want to sell it now. If you want to sell it, how much are you going to be getting from it? We call that one net realizable value. So the net realizable value is calculated as the selling price or the fair value. The fair value less what?
Cost to sell.
Okay. What are the examples of the cost to sell? They can give you examples. They will not give you cost to sell. They will give you examples. What are some of the examples of the cost to sell? Okay. Let's count the examples of disposable cost or cost to sell, any of them. So cost
Agency costs.
Okay, so you can have the agency cost. What again?
Danny?
Agency cost, what again?
Repair cost.
Please, can you mention it again?
That repair cost, at times you need to do some service to the asset before you can sell.
Okay, okay. So,
Maintenance costs.
so someone can see the maintenance cost. Okay. What again? So the agency can also be commission. Are you okay? It can also be commission. You can also have transport.
Cost.
Okay, you can also have transportation. Okay, you can also advertise and sell. So all the costs that you are going to incur to bring the asset to the state that it will be ready for you for sale is what we call. So you can also have legal costs.
Dismantling cost.
Okay, you can also have the dismantling cost. Okay, so you have to dismantle the asset before you sell. Okay, so you look at the dismantling cost. Okay, you only take care of the dismantling cost if you are not going to be carrying out the dismantling. The meaning is that the dismantling has been included in the selling price. So if you're not going to be selling, if you're not going to be doing the dismantling before, then what would have been the cost of the asset without the dismantling? Okay, then you can also have some sales taxes. Okay, if you sell in Ghana here, if you sell, you are going to be getting the capital gain tax and those things. So you can also have some taxes on this one. So they can give you, or the question can give you the cost to what, or the cost to sell. They can give you the figure as cost to sell. Maybe sometimes they can give you the examples. You have to put them together. Okay. So we are saying that the recoverable amount is the higher of the net realizable value, or what we call value in use. Okay. So we'll be looking at how we determine the value in use. Okay, the value in use is if we want to continue using the assets, okay, what is the benefit that will be given to us? So we estimate the benefit that the asset will be given to us. Then we want to look at the today's value because the current value is the present value of the asset. Okay, so we cannot use future benefit in the future terms. So we have to now find the today's value of the benefit that the asset will be given to us. So it is the higher of the current value. The recoverable amount is the higher of the next realizable value or value in use. Our problem will now be how do we carry or how do we calculate the value in use? Okay, the value in use is just the present value of the future cash flows. Okay, the present value of the future cash flows that will be arising from the continual use of the assets. So you either sell it or you want to use it. Okay, you only say you want to use it if you need the asset or you have realized that the asset is going to be giving you more benefit than selling it. But if you realize that if you are selling it, you are going to get more than what? More than the benefit that the asset will be giving to you over the remaining useful life, then you sell it. This is the recoverable amount is being determined from a rational position of the what? Of the entity. Okay, as a rational person, if you are going to be using the asset, it's going to give you a benefit higher than selling it. There is no way you can sell it. The only time you can sell it is something that's just going to be beyond what your control. But under normal circumstance, if you are going to the selling the asset is going to give you a higher benefit than to continue using it, you sell it. The recoverable amount is being determined from the perspective of a rational what entity. Okay, present value of the future cash flows from the continual use of the assets. So the value in use is the present value of the future cash flow from the continual use from the continuous use of the assets. Okay, so how do we determine the future cash flows? This is very important. Okay, if you want to determine the future cash flows, okay, the future cash flow should be based on what? On the conditions, on the assumptions that are directly relating to the assets. Okay, if you want to continue using this asset, what are the things that will happen? Maybe you might be doing maintenance at a particular date. You might be doing this at a particular time. We have to take into consideration all those conditions, all those market conditions that are going to be relating to the what? To the continual use of the asset over its remaining useful life. We can also use the what? Management can also do their cash budget, or we can use their research budget to do the what? To do the estimate over the past years. What is the benefit that the asset has been given to us? So we can base our prediction now on this. And these predictions, if you're using management budget, the predictions to be for only 5 years. Okay, but if you can go beyond 5 years, then you either find an increase in the cash flows. That increase will be at a reducing rate. What do we mean? If you are saying that the asset is going to give us 200 million for 5 years, and the asset is having a useful life of what? Of, let's say, 7 years. The remaining 2 years, you have to now use what? An increasing rate of the asset that is going to be very lower. So if the cash flow is increasing by 5%, in the 6th and then the 7th year, you have to use something like 2% to discount it, unless the 5% can be justified. Okay, but this in exam condition, nobody will worry you with this one within 30 minutes, 36 minutes, or maybe 8 minutes or whatever. Okay, if you are estimating your cash flows, so estimate of the cash flows. Okay, estimate of the future cash flows. Okay, future cash flows. So the estimate of the future cash flow should exclude the following. Okay, the exclusion is very important. So they will test you on the exclusion. Okay, they will text you on the exclusion. Okay, it should exclude any cost benefits or savings that is going to Okay, any cost, benefit, or savings arising from a future maintenance or future work to be done on the assets. Okay, to be done on the assets which the entity is not committed to. Okay, so which the entity is not committed to. I will explain. Okay, so they are saying that after 2 years, the entity is going to do a restructuring, or the entity is going to do a maintenance on the asset. If this maintenance is done, it's going to reduce the labor cost, or it's going to increase the revenue by this amount. You cannot factor in that particular cost savings or that particular increase into the cash flow, because you are not going to be carrying out the maintenance. You are not committed to the maintenance. So you cannot factor in that particular one. So if you are saying that the assets, if maintenance is not done, it's going to give you 200 million every year, that is fine. But if you are saying that if the asset is going to give you 200 million every year, that is a normal cash flow. If a maintenance is done on the asset, it's going to reduce the labor cost by 50. So it means that the labor cost will be additional cash flow, adding to the normal cash flow. Then it means that from year 2 or from year 3, your cash flow now will be 250, which is the normal 200 without the maintenance plus the benefit that will bring in out of the maintenance. That will be 250. Don't do that if you are not committed to the maintenance. But if you are committed to the maintenance, any outflow or any inflow that will be arising from the maintenance should be factored into the future cash flow. So the question now is, if we are saying that we are going to do maintenance at the end of the year 3, this maintenance will be at a cost. So if you are committed to doing the maintenance, it means that at the end of year 3, we are going to be incurring the maintenance cost, which let's say is 20 million as a cost. Then we also have the benefit that will be rising from savings in the labor cost. So we have to provide for the two. We have to factor these two costs, the benefit that will be coming and the cost that we are going to be incurring there. Okay, so you cannot include the cost benefit that will be coming as a result of the restructuring or the maintenance that will be done on the asset at a future date if the entity is not committed to that particular one. It means that we are not sure that we are going to be carrying out the maintenance. So we don't include the benefit that will be coming from the maintenance. Okay. Another one is that we should not include restructuring costs. Okay. Or we should not include, let me just make it very simple. Okay. It does not include obligations that are recognized as liabilities. Okay, they have already been recognized as liabilities. So if you include it again, it means that you are having a double counting. Okay, so if we are going to be doing restructuring on the assets, we have already provided for the restructuring. So it means that the restructuring has already been provided for. So we cannot factor in the restructuring again because we have already provided for that particular one. So we have already provided for that cost. So if you are including it again, it means that you are doing double counting. You are providing for two costs twice. Okay, so obligations that are recognized as liabilities, examples, we have payables already. We have already made provision for these payables. It has already been recorded. So you can't provide for it again. If you are doing it, it means that you are doing double counting. You are accounting for this one particular transaction 2 times. Okay, we also have, let's say, provisions. Okay, but if these provisions are not yet recognized, like dismantling costs, we are estimating the dismantling to be done at the end of a particular period, and that has not been recognized yet. It means that we have to factor in the dismantling cost. It will be a cost that will be paid at the end of the year 3, then we take it. But if that has already been recognized, but just that it will be paid in the future, that is a sunk cost. It's something that has already happened. We don't factor that particular one into this again. The cash flows does not also include does not include, let me, I don't know how I'm going to put it. It does not include returns, or let me say returns from financing, returns for financing activities. Financing activities are not directly related to this one. So example is dividend payments should not be part of this one. Okay, dividend, we are only looking at the cash flows that are relating to the continuous operation of the asset. It should be specific to the asset. It should be directly related to the asset. So example is dividend is not included. Okay, dividend is not included in the cash flow calculation or in the calculation of the value in use. Also, interest is not included. The question can give you finance cost. Finance cost or the interest is not included. Why? Because the discount rate that we use, the interest rate that we use is always what? A weighted average what? Cost of capital. So if you're using a weighted average cost of capital, it means that the interest on the debt has been factored into the cost of capital. So you cannot include the interest again. Okay, we are going to be preparing, if you want to determine the fair value, the value in use, we are going to be preparing something like a cash flow statement. The cash flow statement, we know that interest should be subtracted from profit. But the discount factor that we are going to be using to discount the cash flows, the impact of the interest has already been factored into the what? In the calculation of the discount rate, which is the weighted average cost of capital. Because calculating the weighted average of cost of capital, we include the cost of equity and also the cost of what? The cost of the debt. So it means that the interest has been factored into the cost of debt already. So you cannot include the interest in your what? In your cash flow projection. Okay, because it has been factored into the cost of the calculation of the interest rate already. So I'm not sure. Okay, so cost, benefit, or savings for the future work to be done. If the entity is not committed, obligations that are recognized and the return from financing activities or return or money, or I don't know how I'm going to put it, but it should be dividend and interest. Okay, it should also not take into consideration the impact of what? Impact of tax. So we always use impact of tax, always use what? Pre-tax what? Cash flows. Okay, so the cash flows that you are going to be, the estimate of the cash flows, the future cash flows should only reflect what? Activities that are directly attributable to what? To the operations of the assets. Okay, there can be also a cost that will be incurred to make the asset ready for use. It can be a development product that is still in what? That is still under development. And we want to determine impairment tests on it. We are going to be incurring a certain cost in the future to complete it. So we can also factor in that particular cost when we are projecting the cash flow. What is the interest rate that we use? We are saying that the value in use is the present value of the future cash flows. The present value means that we are going to be discounting the what? The cash flow. So we use what would be the interest rate or the discount rate. Okay, what would be the interest rate or the discount rate? Okay, the interest rate will always be a pre-tax cash flow. For examination purpose, it will be a pre-tax what? Rate. Okay, or it will be a weighted average cost of capital. And this particular one should reflect what? All the market conditions. Okay, so sometimes a question can tell you that the interest rate has taken into consideration the impact of general inflation. So if the interest rate has been adjusted, so we take into consideration the issue of general inflation. Okay, the interest rate has been, if the question says that the cash flow has been adjusted to reflect general inflation, we use what we call a nominal rate. This is a pure financial management that we are doing. So we use nominal interest rate. Okay, sometimes the question can give you nominal cash flows and the nominal interest rate. So if you are giving nominal cash flows, you just use a nominal interest rate. Okay, so if the question says that the cash flow has been adjusted or has been estimated, taking into consideration impact of general inflation, then we use a nominal interest rate. But if they have been estimated without the impact of inflation, we use what we call the real interest rate. Okay, the real interest rate. Okay, when you want to determine the value in use for value in use for what? Asset located in a foreign what? asset located in a foreign country. Okay, it means that the cash flows will be determined in a foreign currency. So if the asset is located, we are in Ghana.
Hello, sir.
Yes, please.
I want of small with the general inflation, the two as well. They still have to use the two.
I can't hear you say.
I said I went off small, the general inflation. You were explaining when to use the nominal and when to use the real interest rate.
Okay, then the nominal is when the question is saying that the cash flow has been determined, taking into consideration the impact of general inflation. It means that the cash flow has been determined, taking into consideration the impact of the inflation on the cash flow. Then we use the nominal. But if the cash flows are being determined without the impact of the general inflation, we use the real interest rate. Okay, so let's come to how to determine the value in use in a foreign of an asset located in a foreign a foreign country. So we are in Ghana here, we have an asset located in Nigeria. Okay, so the asset will be used to generate benefit in Nigeria. So we have to estimate our cash flows in the foreign currency. So what we do is that our cash flows will be in a foreign currency. Okay, our cash flows will be in the foreign currency. So our cash flows will be determined in the foreign currency. So the cash flows will be determined in the foreign currency. Our cash flows will be determined in the foreign currency, and our cash flows will be determined in the foreign currency. Then we discount it in the foreign currency. So you discount it, discount the cash flows, discount the cash flows in the foreign currency. So what we do is that the benefit that the asset will be given will be in the foreign currency. So we try to discount it. Discount means that we find the present value, today's value. Then you translate the present value using the rate at the that day, which is the spot rate. So you translate using the spot rate, the rate at the time of this discounting. Okay, the rate at the time of this discounting. Let's come here. Our cash flows, the cash flows that we are going to be determining, the future cash flows will be including. So we are going to be producing on the asset to sell, and we are also going to be incurring costs. So the cash flows will be the cash inflows that is going to be arising from the use of the asset. So they can give you the sales value, the sales that will be making from the asset. Then we also have the cash inflows, the cash outflows rather. That will be the cost that we are going to be incurring to operate this particular asset. So the question can tell you, they can give you the cost of raw material and all those things, then you determine it. So they can give you the maintenance cost, the repairs, the cost of purchasing material, all those things. Then this will also, because we are looking for the benefit that we are getting from the asset, we also look at the net receivable from the disposal of the asset. So net amount from the disposal of the asset. It's also the benefit that we are going to be getting. Okay, so if you want to continue using the asset, it means at the end of the useful life, you are going to sell the asset. It's part of the benefit that the asset will be giving to you over the remaining useful life. So we use the disposable value also at the end of the useful life of the asset in the cash flow. Okay, let's come here. After determining that there is a possible impairment, we say that you should find the carrying value. You should find the carrying value and also the recoverable amounts. When do we say the asset has impaired? So we say the asset has impaired. Okay, we say the asset has impaired, or there's an impairment loss when the carrying value of the asset is higher than what?
The recoverable amount.
Okay. It's higher than the recoverable amount. Okay, so asset is said to be impaired when the expected benefit is higher than the benefit, or when the expected benefit is now higher than the actual benefit, we say that this particular asset has impaired. If there is an impairment loss, what is accounting treatment? So treatment of an impairment loss. We are doing this for a single asset that can generate cash flow independently on its own. So if there's impairment loss, what we do is that we debit profit or loss with the loss, debit profit or loss, and reduce the value of the asset to this one. So if there's an impairment loss, the impairment loss will be recognized as an expense, then the asset will now be written down to the actual value, which is the recoverable amount. So we reduce the value of the asset and we credit the profit or loss to recognize the impairments. Okay, after the impairment, what will happen? If the useful life is still relevant, we now take the recoverable amount, spread it over the remaining useful life of the assets. Okay, we are doing this for a single asset, a single component asset. What do we call a single asset? Asset that can generate a cash flow on its own. You can see that right now, if you have a delivery van, the delivery van can be used to sell on its own. You don't have to add anything to it. But we call something what we call a cash generating unit. Mostly I use a provision store. So provision store, you are going to be having the items there. You are going to be having the table. You are going to be having the container itself. You are going to be having the bulb there. You are going to be having people there. Okay, the provision store as its own cannot sell. You have to put things in the container. The container itself cannot sell. So you have to now stock the container, and all these things will come together to generate a cash flow. Okay, so that's what we call a cash generating unit, but we will be looking at that later. But before that, let's pick two questions on the impairment of a single asset, and we see what we can do there. Okay, let's move from simple to complex. Someone should read the example for us.
Really acquire. Sorry. Really acquire.
Third page.
I'm sure page 3.
Okay.
Auntie Vic, are you there?
Yes, please, I'm here.
Wait for us.
Okay. Really acquired a non-current asset on 1st October 2009. That is 10 years before 2009.
Forget about them. What they are saying there is a nonsense thing. How can you acquire assets and it will be 10 years before 2009? Forget them. Pay attention to the dates.
Okay, really acquired a non-current asset on 1st October 2009 at a cost of 100,000 cedis, which had a useful life of 10 years and a nil residual value. The asset had been correctly depreciated up to 30th September 2014. At that date, the asset was damaged and an impairment review was performed. On 30th September 2014, the fair value of the asset, less cost of disposal, was 30,000 cedis, and the expected future cash flows were 8,500 cedis per annum for the next 5 years. The current cost of capital of really is 10%. Required with reference to relevant IFRS, demonstrate how this transaction should be accounted for in the financial statement for the year ended 30th September 2015.
All right, thank you. So this one, when are they carrying out the impairment test? You identify the date of impairment, and when are they carrying out the impairment test?
I think 30th September 2014.
Okay,
30th September.
so at that date, you need two things. You need the recoverable amount and also the carrying value to determine whether the asset has impaired. So at the date of the impairment, you need two things. the carrying amount of the asset at that date, which is the value of the asset in your books, and the amount that you are going to be you are going to be recovering from the continual use or the sale of the assets. Then you now compare to see whether the asset has impaired. Okay, so let's come here. We should go there and now do what we call. So let's come to the example 1, which is going to be the really cool. Okay, so when are we doing this? We are accounting for this on what? 30th September 20x4, isn't it? Okay, so we need two things. We need a carrying value. Okay, how do we determine carrying value, Sinners?
The cost of the assets less accumulated depreciation.
So cost minus what? Accumulated DPR. So let's count to the carrying value. The cost of the asset is how much?
100,000 Ghana cedis.
Okay, that is 100,000. Okay, let's calculate the accumulated depreciation now. Depreciation every year will be 100,000 divided by 10. Am I correct?
Yes, sir.
Okay. When was the asset purchased?
1st October 2009.
So we are calculating the carrying value at 30th September 2014. So from 2009, October 2009 to 30th September 2014, how many years is that?
6 years.
Are you sure? Even
It's
if
5 years.
even
5
if,
years.
5 years.
even if you are not sure, you can use this one to determine. So they have given you the cash flows for the next 5 years. Okay. So it means that we have used the asset for what? For 5 years. So what will happen is that our accumulated depreciation will be multiplied by 5. Do you agree with that?
Yes, sir.
Okay. So our carrying value will be the 100,000 minus 50,000. Is that correct?
Yes, sir.
Okay. So carrying value will now give us 50,000. So we need to determine the recoverable amount. So we are giving the net realizable value in the question. How much is the net realizable value?
$30,000.
Okay, 30,000. So we have to find out our value in use. Okay, we have to find out our value in use. Okay, but if the value in use is not given to you, then you use the net realizable value. But we are giving information on how to calculate the value in use. Okay, so let's come to the value in use to now establish. Okay, the value in use to now establish our. Okay, what is the information? The value in use, we say that is the present value of the what? Of the future cash flows, isn't
Cash
it?
flows. Yes,
Okay.
sir.
The future cash flow is how much per
8,500
for how many years?
for the next 5 years.
Okay, so this is annuity, isn't it? Because it's an equal amount every year. This is an annuity.
Yes,
So you can
sir.
use annuity factor to calculate your cash flow. But please don't go there and be doing year 1, year 2, year 3. They are all going to be giving you what we call so don't do it like this. You say years, then you have your cash flow, you have your discount factor, then you have your present value, then you have year 1, 8,500. Year 2, 8,500. Please, you are going to be wasting time. Okay, just calculate a discount factor for the 5 years and multiply. Okay, so we use annuity here. So our present value of the cash flow will be calculated as, okay, this is going to be at the end of the year, so ordinary annuity. Okay, so we use the cash flow, which is 8,500, multiplied by 1 minus into bracket 1 plus 0.1 exponent negative 5, or divided by 0.1. What are we having as the annuity factor? The 3 decimal places. 3 point what?
3.79.
Okay, 3.79. So what are we having as the value in use?
32221.
3, 2, 2, 1. Okay. So what will be our recoverable amount now?
It's 32215.
322.
15.
It might be because of the approximation that you are doing. Okay.
Okay.
If you are calculating, your annuity factor should or your discount factor should always be to 3 decimal places. Okay. So let's see whether it will be 33221.
It's 32215.
The same thing.
I'm getting 32215.
Okay, let me
So
confirm
say,
that.
what I didn't want, I multiplied throughout. I didn't do the to 3 decimal place. That's why I'm having 3221.
Okay, let's use the 3 decimal places, but the difference will just be
Add 3.98.
3 points
3.9875.
3.98.
75.
Says it's 3.791.
Yes. So when you
3.791.
Yes, sir.
yes.
Okay. The person who is getting a 3.9 something, redo it. Okay.
Me, I ran it.
Now if you run itself, it will still be
If you run it step, you
3.91.
should get 3.791.
Okay. So redo your annuity factor. The -5 is affecting only the 1 plus 0.1. Okay. It's not the 1 minus before the negative. No, the -5 is affecting only the 1 in the bracket. Okay. So we have, if we multiply, what are we having? 3,500 multiplied by
Sir,
8,500.
32,223.50.
Okay. So
0.50.
we have 32223.500.
23.50.
Okay. So which of them will be the recoverable amount? What will be the recoverable amount now?
3222.5.
That's the value in use.
Okay. So let's find the impairment loss. That will be 50,000, which is the carrying value minus what? The 3222 3.50. What are we having?
1776.50.
177.
76.
777.
17776. 777.
Okay.
0.50.
Okay. So the impairment loss is now this one. So you debit your profit or loss with this one.
Credit the assets.
So you reduce the asset. The value of the asset will now be the new value, 3223.1. So you credit the asset to be with this one. So that you can now reduce it to this particular one. Okay. So this particular value in use, they can also give us the what? The disposable value. We also have to discount or present value the disposable value. Okay. Let's take the last question. Let me solve the last sitting financial reporting question, which is the last question in these documents. Okay. It's also about this one. 34.
Question 34.
Yeah.
Samoni Limited is undertaking an impairment test for one of its cash generating units, which has a 3-year horizon. Somebody has prepared the following list of budgeted cash flow for the purposes of calculating value in use over the next 3 years. That's 31st December 2024 year end onwards, using 31st December 2023 prices. So you have the cash from sales, cash paid to acquire the inventory, wages and salary, interest paid on loans, tax paid, payment of restructuring costs provided for at 31st December 2023, and then the disposal proceeds. Somebody's weighted average real cost of capital that is adjusted for the effect of inflation is 8% per annum. All Sameni's cash generating units exhibit similar risks. Assume all cash flows occur at the end of each year. Required in accordance with IAS 36, Impairment of Assets. Explain the treatment of each cash flow above and calculate the value in use of the cash generating unit as at 31st December 2023.
All right, thank you. Even if the last side or the last statement is not given to you, please. Cash flows are expected to be what? To be arising at the end of each year. So if you are at the beginning of 2023, it means that you are expecting to get this money at the end of 2023. So the cash flows are expected to be arising 1 year in arrears. Okay, so they are expected to assume or to arise at the end of what? The year. So you can see that we are the end of 2023, isn't it? We are doing this at the end of 2023. So a year from 2023 has to be 2024. That's why they have given these prices here. Okay. All right, let's come here now. Okay. We have to estimate the cash flows on the assets relating to what activities that are directly going to be carried out with the assets. Okay. They say cash from sales. Why are we saying cash from sales? We are going to use the asset to produce, and we are going to sell. This is the value of the sales that we are going to be making. Is this particular one part of the benefit that will be arising from the continued use of the asset?
Yes, sir.
Okay.
Yes, please.
So let's go and prepare the value. Okay, so we just exclude some of the items. That is explained. So we exclude some of the items. So we have the question 34, which is the so many what PLC. So we have the cash flow statement, or we can also name it value in use. Okay, so we have the cash flow statement to calculate the value in use. So what we have is that we have the respective years here. We have 2024, 2025, then we have 2026. So we have the currency sign here to be in million, So the first thing that it's just like how you prepare profits, how you prepare a profit statement, but a profit statement should be only cash transactions. We are looking for only cash profits. So how do you get the profit, which is a cash profit? You are going to be selling and you are going to be paying. That cost will be taken away from the sales. Then you also pay other costs that will also be taken from the sales. Then the remaining one, that will be the cash. It's just like you have sold an item for 10,000, but you purchased the item for 5,000. You have also paid people to help you carry the asset to where you are selling it. You have to take all those amounts of money from the amount that you have realized to get what the amount left. And the amount left in cash is what we call the cash flow. So let's come to the cash sales now. Okay. The question,
It's 1,000, not million.
they are all in thousands. Okay.
Yes, sir.
So the question can also give you information on credit sales. Credit sales is not a cash item. We use only cash item. Let's look at the sales for the first year, which is at 2024. What is the sales? It's not points. It's actually supposed to be comma. So 2875.
3,880.
Okay.
The figures are in millions. So
Are you sure?
They're in thousands.
Okay.
if you look at
2875. What again? 3,000 what?
2250.
2250.
Okay, 2250. Okay, 2250. Before we sell, we need to buy the what?
The items.
Okay.
Items.
So we need to
And
have
the
purchases
process.
there. So the purchases should also be cash. Okay. What is the purchases?
1437.5.
1437.5. Okay.
1500.
1,500.
15.
1500.
100.
Okay.
And then 1125.
So 1125. Okay. Let's go there. Let's see whether
Wages
another
and
cost will
salaries.
come there. Wages and what? Salaries.
Wages and salaries.
Salaries.
So wages and salaries will come there. Okay. 2024 is how much?
562.5.
562.5.
562.5.
It runs through all.
They are all 562.5.
Yes.
Yes, please.
Okay. Okay. So do you have any other cost again? Interest paid on loans. That we have said that has already been factored into the
That
cost
should
of
be,
what?
yes.
Cost of capital.
Yes.
Tax paid.
Excluded.
Excluded.
Payment of restructuring costs provided for at 31
Excluded.
December 2023.
Excluded.
This has already been provided for what? As a liability. So that will be
Some
excluded.
cost. Yes.
Okay. So what we do is that let's find the cash profit. Let's find profit first before we add the disposal. So what will be the cash profit?
The first one is 875.
875. Okay.
The next one is 937.5.
937.5. Okay.
The last one is 750. 750.
No, there's 0.5 on it too.
No, it's 562.5.
562.
0.5.
Okay.
Yes. 562.5.
Okay.
2.5. Right.
So what will come here? Do you have any disposal value there?
Yes.
Okay.
Without
Disposal
process.
will be, when are we going to receive that?
Third year.
2026.
How much is that?
625.
625.
625. So let's have total to have our total cash flows now.
875.
875.
937.5.
93.5.
1187.5.
87.5. So they're asking us to determine what? Value in use. We have to present value this one. So you have to bring your discount factor now. So this is just like the discount factor is 8%, isn't it?
Yes, please.
Okay. So 8% the first year, that will give us 1. So we use a normal discount factor because these are all future values. They are not annuity. So 1 over 1 plus 0.8 exponent 1. That will give us the first one. So
0.926.
0.926. Okay. The last year, the second year will give us what? 1 over 1.08 exponent 2.
0.857.
0.857. Okay.
0.794.
0.794. Okay, if you multiply, what are we having?
The first one is
0.25.
8.25.
801.
810.25.
Okay.
The second one
The
is
last one.
803.44.
803.44.
Okay, 803.44.
The last one is 942.88.
942.
0.88.
Okay, 942.88. So what you do is that you just add it, you add all. So if you add all, that is the value in use. Very simple. Okay. It was just like I had an idea about maybe if this question will come. So we have a similar question in pre-mock but just that we didn't do we are not giving, we are giving the sales for each year with each corresponding increment. So yeah. All right, so let's now go to what we call a cash generating unit. Impairment of what we call a cash generating unit. Okay. So we're looking at impairment of cash generating unit. Let's see if we can. Okay, we still have about 1 hour 30 minutes, isn't it? Okay, we can do.
Yes, sir.
We can do two examples under each of them. Okay, then. Okay, so let's come to what we call a cash generating unit. All that we have done right now is for a single asset. What do we call a single asset? Asset that can generate a cash flow on its own. Okay, but we have asset that they cannot what? The assets they cannot
Hello,
generate
sir.
cash flows in the senior.
Hello, sir.
Yeah.
The last discount, but I'm getting 0.7938.
Yeah, we normally do it to 3 decimal places.
The
So
third year.
we normally discount it, or we normally approximate it to 3 decimal places.
Okay.
So that is approximation.
Okay, thank you.
All right.
Okay, thank you, sir.
Okay, what we have done, the 2 examples that we have solved now, is actually for a single asset that can generate cash flow on its own. But what if the asset will come as a group to generate cash flow? Mostly I use the provision store as an example. So the table in the container cannot generate a cash flow on its own. You have to put something on the table. You have to put lightning should be there. The container itself should be there, and the lamp should be there. So a lot of things will come together before you sell. So the provision store can be treated as a cash generating unit. If there is an impairment, how do we account for that particular impairment? There's an impairment of the cash generating unit. How do we account for it? So it means that we have to share the impairment according to the asset that we have in the group, if all the assets are going to be impairing. So what will happen is that, assuming we have furniture, okay, we have furniture to be 20 million, then we have assets, we have the furniture to be 20 million, we have plants, so these are all in a group, 25 million, and we have, let's see, we have land to be 20 million. Now let's say we have inventories to be, let's say, 10 million. So let's say we don't have any payables, we don't have any liability, so we total this one, so 20 plus this one, we are having 75 as a total. Okay, so the question can give you the recoverable amount of the cash generating unit as a whole, or sometimes it can give you information for you to calculate either the recoverable amount, or maybe you calculate the value in use together with the recoverable amount. They will give you information. You calculate the net valuable values and the value you use to determine the recoverable amount, or sometimes the question can give you that information directly. So maybe they have given us the recoverable amount to be 60. Okay, they have given us the recoverable amount to be 60. Okay, and they haven't given us any information about which of the asset that has impaired. Okay, so the carrying value of the asset before the impairment is 75. They are now saying that the recoverable amount is now 60. What will be the impairment loss?
15.
Okay, the question now is, how do we share the 15 to each of these assets over here? They haven't told us which of the assets has impaired and which of the assets has not impaired. How do we share? What's the best proportion do you think we can use to share the 15? The 15 is actually for the total of 75. It's for the whole group of assets, isn't it?
Yes, sir.
So how do you think we can? What is the best way of sharing this 15?
Approximation.
I use the weighting.
I think you can use their weight.
Okay, we can use their value. So this is 15 is for 75. So 20 over 75 multiplied by 15, isn't it?
Yes, please.
Okay, so that is the default method of sharing it. But sometimes there can be certain assets in this particular unit that will automatically impair. there can be certain assets in this particular generating unit that will automatically impair. Okay. We can also classify a subsidiary as a cash generating unit. So you can also take note of that. And we can also have impairment of subsidiary. That will be solved in corporate reporting class when we are doing question solving. Okay. So we can have certain asset that will be what? That will be included over here. So there can be a situation where we have a goodwill in this one. And the goodwill will actually be, okay, let's say the goodwill will actually be 5. Okay. Your cash generating unit cannot be what? Impairing. There is not there was a flood at where your container is located. And now that particular place is now what? It's now damaged. You cannot even sell again. Will you say that you still have a good, will you say that you still have a good location that is going to be giving you money? No. So it means that a goodwill will automatically will always take the goodwill. Okay. So we can have certain asset that is going to be automatically be impairing from the cash generating unit. So how do we go about it? We are first apportioning the impairment loss to them before we count to the ones that we cannot share. So we are now pro rata the remaining one. So if there is an impairment of cash generating unit, how do we allocate the goodwill? How do we allocate the impairment? Allocation of the impairment loss. Okay. Allocation of the impairment loss. The first one is you ask yourself, is there any physically damaged assets? So if there is any physically damaged assets, the question will tell you that this particular asset has been damaged beyond repairs. So it means that you should write it off. That is the first asset that has impaired. So that should take the impairment first. So physically damaged asset should take the first one. If there's no physically damaged asset, or the goodwill cannot be written against the goodwill. The impairment loss cannot be written fully against the physically damaged asset. Then goodwill will take the next one. After the goodwill has taken, we still have some portion of the impairment loss. Then you now share among the possible impaired assets. So the question will be telling that the value of the inventory is the same as its recoverable amount. So it means that this will not be impaired. But if nothing has been said about the inventory, please, the inventory will also be assumed to be impaired because it's also part of the cash generating unit. So we now prorate the remaining impairment based on the carrying value before the impairment. The remaining impairment loss. The remaining impairment loss based on, so we have the remaining impairment loss based on the carrying value. Okay, based on their carrying value before the impairment, which is what we have established first. Okay, let's come here. This is very important. Sometimes the question for the cash generating unit, sometimes the question can give you both the net realizable value and they also ask you to determine the value in use for what? For the cash generating unit. If you are apportioning the impairment loss, come here. Assuming the impairment, if you want to apportion the impairment here, let's say we have taken the 5 to goodwill. Okay, we have taken the 5 to goodwill, and we also assume that the inventory will also not be what? The inventory will also not be impaired. How do we share the remaining 10? How do we share the remaining 10 among them? That will be 20 divided by 60 multiplied by 10. Is that correct? For the first one, which is furniture?
Yes, please.
And the plants will be 20 over 60 multiplied by 10. Then we also have the land, 20 over 60 multiplied by 10. What are we guys having for them? I'm having 3.33.
3.33.
3.33.
Okay, 3.3. Okay. So you can see that the impairment that we are going to be subtracting from this asset will be 3.3, isn't it?
Yes.
Okay. But sometimes the question can give you the net realizable value of the furniture to be 18. The question can say, you see that the carrying value is what, 20, but the question can tell you that the net realizable value is 18. So it means that the furniture has reduced by how much?
2.
It has reduced by 2. So you cannot write the 3.3 against the furniture. You only write the impairment loss to the asset to what? To its net realizable value. you cannot write below the net realizable value given to you, and you can also not write below 0. So if this particular asset over here is having only 2, and the impairment is 3.3, you cannot take all the 3.3 to this one. You take only 2 to that one. So if 2 has been taken to this one, what will happen is that you will now bring the remaining impairment to these two and share. You now bring the remaining impairment to these two to share. You don't have to what? Share. You cannot write down the carrying value of the asset below its net realizable value. So if they have given you 2, they have given you 20, and they have given you a net realizable value of 18 relating to the furniture, you cannot say you are going to be writing 3.3 against the what? The furniture. You only write to what? To reflect this particular one, which is a 2. So you write a 2 against that, and the remaining impairment will now be shared among this one in their proportion. You have to take note of that. So if you share sometimes, after sharing, what is the value left? That value, if you can write up to the net realizable value, you can write. But let's come here. Assuming they have also given you 70 for this one, it means that the impairment loss that can be written against the plan should also be 3, isn't it?
Yes, please.
Okay. So this will now be 5. The remaining one will now be, the remaining impairment will be 5. So the 5, if you are not giving any value of the land, then you write all the 5 against the land. But let's say you are giving 17 or 16 for the land. It means that the land has also impaired by 4, isn't it? So you write
Yes, sir.
only 4. The remaining one, throw it away. Okay, the remaining one of the impairment, just throw it away, because there is no asset that you can write the one against. Okay, so you cannot write down the carrying value of the asset below its net realizable value or below 0. You have to take note of that, because you are going to solve a question where that is applicable. That's why I'm saying that. Okay, that's why I'm saying that particular one. Okay, let's pick one question so that we can use it to solve. We can use it to explain all those things. Okay, let me come here. What is that question? Okay, let's look at question number 21.
Question 21.
Yeah.
Sandu Limited is a company which manufactures machinery for industrial use and has a year end of 31st December 2021. The directors of Sandu Limited require advice on the following transaction. A. Sandu Limited acquired a cash generating unit several years ago, but at 31st December 2021, the directors of Sandu Limited were concerned that the value of the CGU had declined because of a reduction in sales due to new competitors entering the market. At 31st December 2021, the carrying amount of the assets in the CGU before any impairment testing were, we have PP 20 million, goodwill 6 million, other assets 38 million. B, the fair values of the property, plant, and equipment and the other assets at 31st December 2021 were 20 million and 34 million cedis respectively, and their cost to sell were 200,000 and 600,000 cedis respectively. The CGU's cash flow forecast for the next 5 years are as follows. C, the pre-tax discount rate for the CGU is 8%, and the post-tax discount rate is 6%. Sandu Limited has no plans to expand the capacity of the CGU and believes that a reorganization would bring cost savings, but no plan has been approved. The directors of Sandu Limited need advice as to whether the CGU's value is impaired. The following extract from a table of present value factors has been detailed below. Required, with reference to relevant international financial reporting standards, advise the directors of Sandu Limited on how the above transactions should be accounted for in each financial statement as at 31st December 2021.
Okay. So please, they say advice. You are going to be speaking English, but you can't speak English without what? Without the figures. Okay. We have been given, when are we doing the impairment test? When are we carrying out the impairment test? When are we carrying out the impairment test?
31st December 2021.
Okay, that is at the end of 2021. So what is the, are we giving the carrying values?
Yes, we have the carrying value.
Okay. So what you do is that go and repeat the carrying value again. So let's go and repeat the carrying value there. So question 21, which is a do limited. Okay. So we look at the carrying value before the impairment. So the carrying value at 31 December 2021. What are the assets that we have?
Yes.
PPE.
Plant and equipment.
PPE.
The first one is PPE.
Yes.
Okay, how much is it?
20 million.
Okay, 20 million. Okay.
Goodwill.
Goodwill is what?
6 million.
Okay, 6 million. Then we
Other
have
assets. Other
other
assets.
assets.
38.
38, isn't it?
Yes.
Okay, the total is 64. Okay. So what is the next thing that we have to calculate?
The net realizable value.
Now we have to calculate recoverable amount. So the recoverable amount, we have to know either it is net realizable value that we are going to use or value in use. Are you okay? So
Okay, sir.
we need the recoverable amount. Okay, the recoverable amount, we know that is the higher of the net realizable value or the value in use. So we have to go and ask ourselves, do you have information that we can use to calculate the net realizable value?
Yes, please.
Okay, what are the information?
We have on footnote B, the fair value of the property, plant, and equipment and other assets at the end of 31st December 2021 were 20 million and 34 million respectively.
Okay, so this
And
information given to you over here is about what? The net realizable value. You can see that they are saying that fair value of the asset, property, plant, and equipment, and other assets at 31 December were 20 million and 34 million. That is their fair value. That is their market value. But if you want to sell, this will give us what? You have to sell. You have to incur a cost of 200 million to sell the property, plant, and equipment, and 600,000 to sell the what? The other assets. So you have to put this together and find your net realizable value. So let's come to the net realizable value at 31 December. So whenever they are giving you information about fair value and the cost to sell, they are giving information to calculate the net realizable value. Okay. So we have PPE. What is the fair value for the PPE?
20 million.
The fair value?
20 million.
Yes, 20 million.
The other asset is what?
34 million.
34 million. The cost to sell, the total cost to sell is how much?
0.8.
Okay. So that will give us 0.8. What will be the net realizable value on total basis?
$53.2.
Okay, 53.2. Okay, so you have 53.2.
Sir, please, we can't see
It's
your board.
53.6.
53 points, no. 20 plus 34 minus 0.8. What are we having?
So 53.2.
54.8.
Hey.
Hey.
What are you?
53.2.
53.2.
0.2.
Okay, 53.2. So we have to now calculate the value in use because we have information to calculate the value in use, isn't it? All right. So we have the years, we have the cash flow, we have the discount factor, then we have the present value. So let's
Hello,
go through.
sir.
Yes, please.
My network and sir. Hello,
Okay.
sir.
Yes, please.
Please, your body is like it's not showing.
It's your
Or
network.
it's only my network.
Yes, please. Yes.
Hello.
Yes, please.
Sir, please, are we not adding the value of the goodwill to the
Goodwill has no
realizable
realizable
value?
value. Goodwill has no realizable value.
Oh, okay.
Yeah. It means that the goodwill has totally been impaired. They haven't given us any value of the goodwill. So don't go and say you want to use the goodwill. You cannot sell the goodwill. So these are the assets that you can sell. So it means that goodwill has no realizable value. Okay. Let's come to the value in use. Which of the cash flows are we going to be using?
Pre-tax cash flow.
Pre-tax cash flow.
Pre-tax cash flow.
So we use pre-tax cash flow. So we start from 2022. Please, they can give you 2021 cash flow. Ignore it. Cash flow should be arising a year from now. So we have 2022, 2023, we have 2024, we have 2025. Do you have 2026?
Yes, please.
Okay. 2026 is the last one, isn't it?
Yes.
What is their respective pre-tax cash flows?
16, 14, 10, 6, and 26.
Okay. What will be the discount factor that we'll be using?
8%.
8%.
Okay. You said the discount factor should be what?
8%.
Let me check that one. Okay. So why should they? Okay. So they have brought the
They've
figure
even
for
stated it.
Okay. So the pre-tax discount rate is what? 8%. So let's go to the what? The discount factors given to us. They have for financial reporting and corporate reporting. They are not expecting you to memorize the what or to calculate these things. So they will give you the discount table or the annuity table. They will give you the value that you should be getting there. Okay. They will always give you the value that you should be getting for them. So let's come to year one, which is the year one is the 2022. Are you okay? Okay. So what are we having? What is the discount factor there?
0.9259.
Okay.
0.8573.
0.8573. Year four. Year
Zero-
three rather.
0.7938.
0.7938. Year four.
0.7350.
7350. And year five.
0.6806.
0.6806. If you multiply, what are we having for each of them? So some people should be multiplying one, others should be multiplying the other one too.
The first one is 14.81.
14.81. Okay. I'm having the last one to be 17.70. Okay. 17.70. Last one, 17.70. Okay, 12.0.
12.00.
Okay, 12.00.
7.94.
The third one.
Yes,
Yes,
please. 7.94.
Okay.
4.41.
4.41. So let's total all.
56.86.
56 point what? 86. So what would be the recoverable amount?
The value in use.
The value in use.
56.86.
So let's calculate the impairment loss. That will be 64 minus what? 56 point what? 86.
0.86.
What are we having?
7.14.
7.14.
Okay, 7.14. How do we share this?
Goodwill is already out.
Okay, so we have the allocation of impairment here. Allocation of impairment. Goodwill will take how much?
6.
Okay, so goodwill will take 6. So if goodwill is taking 6, let's come here. Goodwill will take 6. Okay, if goodwill is taking 6, what will be the remaining portion of the impairment?
The remaining portion will be for the other assets.
Okay, the remaining portion is what?
Will be for the other assets because the net realizable value of the PPE was 20,
No,
which
please.
will win
It's
charge.
not 20. It's not 20.
It's 20 million.
It's 19 point.
It's not 20.
We are incurring a cost. We are incurring
You
a
didn't
cost
take
of
out the
200,000.
cost to sell.
We are incurring a cost of
Okay,
200,000 to dispose what? The PPE, isn't it?
So the
Okay.
NRV for the PPA is 198.
Okay.
That's a 19.8.
So we have the PPE to take what? 0.2, isn't it?
Yes.
Okay, because the net realizable value will be the 20 million minus what? The cost that we are incurring, which is what?
0.2. That is 19.8.
19.8. Then you go to the carrying value. The carrying value is also 20, isn't it?
Yes.
So the difference between the two is what? 0.2. So
0.2.
you only
Exactly.
write to the net realizable value, which will be 0.2. The remaining one, let's calculate the other asset. What is the?
Hey, sir,
Yes, please.
please, I don't understand though.
The remaining one is 33.8.
So how did you arrive at the 0.2?
The question, okay. The footnote B. Read the footnote B for us.
200,000 for.
The fair value of the property, plant, and equipment and the other assets at 31 December 2021 were 20 million and 34 million respectively, and their cost to sell were 200,000 and 600,000 respectively.
Okay.
How that is working now? So the net realizable value of the property, plant, and equipment will be the fair value minus the cost to sell. That will be 19.8. Okay, but the carrying value is 20. So 20 against 19.8, the difference is 0.2. So it means that we can only impair the property, plant, and equipment by the difference between the carrying value and then the net realizable value. That is 0.2. But if we take 0.2 from 1.4, what will be left?
1.2.
Okay, but you can see that the 1.2 can be written against what? Against the other assets. Because its net realizable value is 34 against this one. So that will be 33.4. Is that correct? Against this one. So you can see that the impairment is that huge for it. So you can take all the 1.2. So we take the 1.2 to the other assets. Okay. So the total will now give you 7.14. So you can actually do your carrying value after the impairment. That will also give you some marks there. Carrying value after the impairment. So your property, plant, and equipment will now give you 20 minus 0.2. That will give us 19.8. Then you now come to your other assets. Your other assets will now be 38 minus 1.2. What are we having?
Sir, I want to take us back small. The calculation for the allocation.
Yeah.
If you add the figures, you will have to reduce the other asset to 0.94.
0.94.
Really?
Yes, please.
1 point.
So you have 6.
So that one is
Which is the good
1.14. The difference between is it 1.14 or
1.14.
0.94.
1.14? Okay. So, hey, it's 1.14. So this will be 0.94.
Correct.
Okay.
Thank you.
So this will be 0.94. So what are we having?
Senior. Hello, senior.
Yes, please.
Miss of the 0.94 for the other assets. I'm confused too.
Oh, the impairment that we have is 7.14, isn't it?
Mm-hmm.
Goodwill has taken 6. What will be left?
Okay. I'm not having calculator. Somebody should do it for me.
1.14.
1.14.
Okay.
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 Minus
PP
2.
will take
Minus
0.2. What are we
0.2.
having?
1.12.
No, if PP is taking,
0.94.
I'm having
Okay,
0.94.
0.9. Yeah.
Okay. So if you subtract 0.94 from 38, what are you going to have?
Okay. Okay.
37.06.
37.06.
06.
Okay. What are you having? If you put them together, what are you having?
56.86.
56.86. What is that mistake that you should not do? Okay. If you look at the net valuable value of the other assets, it will be 38. It will be 34 against what 0.6, isn't it?
Yes.
Okay. And that will give us 33 point what? 0.4.
0.4, yes.
Okay. Don't say that you are going to compare 33.4 against the carrying value. Then you'll be writing this particular asset by the no. We are going to share only the actual impairment among them. Although it has impaired, based on the information that we have, it has impaired more than that. But the question is telling us that the impairment is 7.14. So after sharing it, what portion will go to the other assets? That is what we are going to be taking. So don't go and look for a difference over here and say that you are going to write it. You only share the impairment that has been calculated. All right. So, okay, this is a very comprehensive one.
Sir,
Yes, please.
but to seek for further clarity, for the PPE, we
Yeah.
use the other cost to sell, which is the 0.02.
Yes, please. Why are we using the 0.2? Because the carrying value is 20 and the net realizable value is 19.8. The difference between them is what? Is 0.2. It's not a cost that it's just a coincidence that it's the same as the cost.
Okay, I agree.
Okay. Let's look at reversal of impairments. Okay. The condition that is actually bringing the impairment might no longer be there. How do we go about it? Okay. So if the condition,
Yes, sir.
Yes, please.
Please, the 094, I don't understand how you got that one.
The meeting is recorded, so that will be okay. Or let me finish, then I will explain that one back. Okay. Because I have 1 hour and I have 2 things to do within the 1 hour. So let me finish, then I will take that one back. Are you okay? Okay. So Senior, let me finish and I will take that one back. Okay. So the 0.94, I will come and explain it later. Let's come to reversal of impairment. Okay. There was an impairment which is being caused by a particular condition or situation. What if that particular condition or situation is no longer there? What will happen? We have to now re-estimate what the recoverable amount of the assets. So let's say that the government has passed a legislation that we should produce below our capacity, and for that reason we have carried out an impairment test. Okay, we have carried out an impairment test. After 2 years, the government has now taken that particular legislation, and we can still now produce up to our full capacity. So it means that the condition is not there. So we cannot be carrying the assets as if the condition is still there. We have to now recalculate this one. Whenever there is a situation for a reversal of impairment loss, what we do is that if the impairment has occurred 2 years ago, okay, and now they are saying that the impairment the condition is no longer there. What you are going to be doing is that you have to now determine the recoverable amount to be given to you. But you have to now ask yourself, if the impairment has not occurred, what would have been the carrying value of the assets? Okay, so that will be looking at this one. So the easiest way that you can do this is this one. Okay, let's say that we have purchased an asset. We have purchased plants. Okay, let's say we have purchased plants at a cost of 20,000, and the useful life is actually let's say the useful life is 10 years. Okay, let's say that is 10 years, and the asset was purchased on January 2021. Okay, at the end of December 2021, we have carried out an impairment test on these assets. December 2021, we have carried out impairment test on our assets, and the recoverable amount given to us was actually, recoverable amount was 16,000. Okay. Okay, let's calculate, let's account for this one. How do we account for this one? We need to know the carrying value at the end of the December 2021, and that will give us the 20,000 minus what? 20,000 divided by 10. Is that correct?
Minus 2,000.
Okay, that will give us 18,000. Then we count to the recoverable amount is 16,000. What is the impairment loss?
2,000.
That will give us 18,000 minus what? 16,000. That will give us 2,000. Okay, that will give us 2,000. All right. Now, the value of the asset will now be 16,000 from 2022, the beginning of 2022, and that will be having a useful life of 9 years. Is that correct?
Yes, please.
Okay. So I don't want to get a decimal. So let me see whether 16,000 divided by 9 will give me proper answer. No. Let's also assume that the useful life has now also been revised to 8 years. Okay, the useful life has also been revised to 8 years. So at the end of the year, the useful life has been revised to 8 years, and the recoverable amount has been given to us as what? As 16,000. So there is the useful life has been revised to 9 in total. So we have used one already, remaining 8 years, so that we can get an actual figure. So we have used this particular asset for additional 2 years. Okay, we have used this asset for additional 2 years. So let's say that additional 2 years. Let's say that at the end of 2 years will be 2022 and 2023. So let's say that at the end of 2023, they are now telling us that the condition for carrying out the impairment test is no longer there, and the recoverable amount has been determined to be, let's say, let's say 18,000, or let me say 16,000, the same 16,000. Okay. So the question is, before this particular information has been given to us, we have to depreciate our asset in our books for additional 2 years, isn't it? Before this particular information was given to us, we are going to be depreciating the asset for 2022, 2023 years.
Yes, 2022, 2023.
Okay. So the carrying value of the asset at this particular date in our books will be 16,000 minus 4,000. Is that correct?
Yes, please.
Okay. And that will give us what? 12,000.
12,000.
So this is the carrying value. Assuming this information is not given to us, this is the carrying value. Okay. This is the carrying value. Okay. They are saying that the condition that is making the asset to be impaired does no longer exist. What you have to do as this date is that if the condition does no longer exist, it means that the impairment should not happen in the first place. So you ask yourself, the condition does not exist. So we assume that the condition does not exist at the beginning of the year. Therefore, the impairment should not happen in the first place. Or you assume that this date, at this particular date, this is the first time that you are coming to carry out the impairment test on the assets. Okay, this is the first time, the time that you are going to be reversing the assets. You assume that is the first time that you are going to carry out an impairment test on the assets. If this is the first time, then what should have been the carrying value of the assets? Or you assume that the impairment has not happened in the previous year. If the impairment has not happened, what would have been the accounting treatment for the asset up to this year? That's what we are going to be doing. So if the impairment has not happened, the asset will be carried at cost of 20,000, depreciated over what, 10 years, if the impairment has not happened. Is that correct?
Yes.
Okay. So if the impairment has not happened, what would have been the carrying value of the assets? What would have been the carrying value of the asset as at this date? This will be 20,000 minus what? 20,000 divided by 10 multiplied by 3. Are we correct?
Yeah.
Okay. That will give us 20,000 minus what?
3,000.
Minus 6,000.
Okay.
That would have given us 14,000.
6,000.
Okay, that would have given us 14,000, isn't it?
14,000.
Okay.
Yes.
So if the impairment has not happened, the carrying value of the asset should have been what?
14,000.
Okay, what is the recoverable amount at this date?
16,000.
No, the recoverable amount at this date is what?
16,000.
16,000.
So it means that the asset has not impaired. If the
Okay.
impairment has not happened, the carrying value at the day that they are giving this thing to us would have been 14,000. They are giving a recoverable amount of what? 16,000. It means that the impairment should not happen in the first place.
Yeah.
Or let me take it again. You assume that that is the first time, the time that you are going to reverse the impairment. Assume that that is the first time that you are going to be carrying out impairment tests on the asset. So there was no previous impairment. There was no previous impairment. The asset should have been 20,000 divided by 10 years, depreciation every year. Now, they have given you a recoverable amount at this day. So what should have been the carrying value? The carrying value would have been 14,000. But what is the carrying value in the books of the entity?
12,000.
So what do we need to make it now 14,000?
We add back.
Okay, so what we do is that you debit the asset with the 2,000.
2,000.
Then you credit what?
Credit P&L.
P&L. That is the reversal of the impairment. So this is how we go about the reversal of the impairment. We are reversing all the 2,000 because there's a change in the useful life. Sometimes you reverse lower than the amount that has been recognized as impairment. We are reversing all the 2,000 because of the change in the useful life. Okay, because of the change in useful life. So let me take the reversal again. I will solve a question on it, but let me take it again. When you are going to do reversal of impairments, or the question is saying that the condition that is causing the asset to be impaired does no longer exist. At that date, just ask yourself, if the impairment has not been done, what would have been the carrying value of the assets? Then you compare with what the recoverable amount to know whether the asset has actually impaired or not. Or you assume that the entity has not carried out any impairment test on the asset until the time that they are giving you the new recoverable amount for the reversal. Then if this is the first time that we are carrying out the impairment test, what would have been the carrying value? You calculate the carrying value, 14,000. Then you now compare, because this is our first time. Does the asset actually impaired? No. Then, if the asset has not impaired, the carrying value should have been 14. But how much do we have in our books based on the first impairment? It is 12,000. How much should be added? That amount should be the reversal of the impairment. Okay, so you just ignore, although you are going to account for the previous impairment, but ignore that the first impairment has not happened. So you assume that this is the first time that you are coming to do it. So what would have been the carrying value if this is the first time? The carrying value will be calculated on the original cost up to today. Then you compare with the recoverable amount given to you, whether the asset has actually impaired or not. If the asset has impaired, then you now do the necessary adjustment. So let's see a question. Then I'll do impairment of corporate asset. Then we pick, if you have time, we pick additional question. Then we see what we can do. But what we have to do is that we don't reverse impairment on goodwill. You have to take note of this. Reversal, impairment on goodwill is not what? It's not reversible. Okay. Impairment on goodwill. So they can give you a cash generating unit and the goodwill will be part. We don't reverse impairment on goodwill. So impairment on goodwill is not what? It's not reversible. Okay, what do we mean by that? Any increase in the goodwill is going to be attributed to increase in the operation of the entity. okay, which cannot be separated from their normal activity. So any further increase in impairment is treated as internally generated goodwill, which is prohibited from recognizing by intangible asset, IAS 38. So reversal, impairment on goodwill is not reversible because we assume that whatever is bringing that one is something that is internally. That is something. It's the workers. The workers, the salary that you are paying to them, you cannot depreciate the amount that you are paying for the attire they are putting on and the knowledge that they are putting there. You are paying for the what? For their services. Their service can include the food that they will come there and eat, the attire they will put on, the food that, because you consider all those things that you are paying them. So can you be able to differentiate that, okay, the knowledge that you are paying for, this is the amount. So we say that that is actually internal generated goodwill, which the cost cannot be separated from the normal activities of the what? Of the entity. Therefore, impairment on goodwill is not what? Is not reversed. But impairment on other assets other than goodwill should be reversed if there is a possibility to do so. I have a very simple question here. Let me check and okay. Let's take the question number 17.
Question 17. Boxer purchased a non-current asset on 1st January 20X1 at a cost of $30,000. At that date, the asset had an estimated useful life of 10 years. Boxer does not revalue this type of asset, but account for it on the basis of depreciated historical cost. At 31st December 20X2, the asset was subject to an impairment review and had a recoverable amount of $16,000. At 31st December 20X5, the circumstances which caused the original impairment to be recognized have reversed and are no longer applicable, with the results that recoverable amount is now $40,000. Required, explain with supporting computations the impact on the financial statements of the two impairment reviews.
All right. So the asset was purchased on what? 1st January 2X1, which is the same as 2011. Okay. At a cost of what? 30,000 with a useful life of what? 10 years. Okay. Boxer does not revalue. I've said that if it is asset that is carried under revaluation model, impairment is treated in line with what? How we treat revaluation surplus and loss on asset carried under revaluation model under IAS 16. Okay. Let's come here. Okay. At 31 December 2X2, the asset was subject to an impairment review and a recoverable amount of what? And had a recoverable amount of $16,000. Okay. So we are carrying out the impairment test after how many years of purchase?
2 years.
Okay.
Yes.
So we need to do the first accounting. How do we go about that? You have to come here and see question number 17, which is a Boxer. So we come to at December 2X2, which is the day that we are doing the impairment. We need two items. We need the carrying value and the recoverable amount. So our carrying value is calculated at the cost minus the accumulated what? Depreciation. So we have the carrying value. The cost is what? 30,000, isn't it? Okay. Our accumulated depreciation will be 30,000 divided by 10 multiplied by what? Are we okay with that?
Yes, please.
Okay. So the carrying value will be equal to 30,000 minus what?
6,000.
6,000. What are we having?
24,000.
24,000. What is the recoverable amount?
16,000.
So what is the impairment loss?
8,000.
Okay. So we have the impairment loss of what? 8,000. Okay. So subsequently, this particular subsequently, so let's come to, let's break this one down. 2x3, at the end of 2x3, we are going to be doing depreciation of what? Depreciation of 16,000 divided by
8 years,
8 years. So every year it will be what?
2,000.
2,000. When are we reversing?
2x5.
Okay. So we have to ask ourselves, okay, at the date of 2x5, what is the carrying value in our books? Based on the calculation that we are going to be doing, what will be the carrying value in our books? Would that be 16,000 minus 6,000?
Yes, sir.
Okay. So that will be 10,000. Because the asset will be carried at 16,000. Depreciation will be 2,000 every year. So 2x3 will be 2,000. 2x4 will be 2,000. 2x3 will be 2,000. It means that we have used 3 years out of that. And that will give us 6,000. So we take the 6,000 from this one. This is the calculation based on the what? On the impairments. Okay. But they are saying that at the end of 2x5, which is 2015, okay, it should be 2015. Okay, but let me make it 2x5. Okay, the condition that is causing the impairment is no longer available, and they have given us a recoverable amount at that date to be what? At that date to be 40,000, isn't it? Okay. For you to know the amount that you are going to be reversing as the impairment loss, for you to know the portion of the impairment loss that you are going to be reversing, you just assume that the first impairment has not happened. So this is the first time that you are coming to carry out impairment test on the assets. You assume that the first impairment has not what happened, and this is the first time that you are coming to do it. And then first impairment has not happened. What would have been the carrying value of the assets at the end of 2x5? If the first impairment has not happened, what would have been the carrying value of the assets at the end of 2x5?
15,000.
That would be, the carrying value would have been 30,000.
30,000 less the accumulated depreciation of
Okay. Let's
3,000 per year.
the depreciation of 30,000 divided by 10 multiplied by 5, because we use the assets from that date to now is 5 years. Okay. And that will give us what? 30,000 minus 15,000. Okay. That will give us what? 15,000, isn't it?
Yes, please.
Okay. So if the impairment has not happened at all, and 2x5 is the first time that we are carrying out the impairment test, would the asset be impaired at this particular date?
No, sir.
Because the recoverable amount is 40 and this is now what? 15. Okay.
15.
So if the asset has not happened at this particular date, it means that the asset should be carried at 15,000 in our books. But what is the value of the asset in our books?
10,000.
So what do?
We add back.
So we debit the asset.
Then credit P&L.
Okay, we debit the asset by 5,000. Then we credit the P&L with the impairment loss. So the reversal of the impairment loss is what? Is the 5,000. Okay. What is the actual, or what was the actual impairment recognized?
8,000.
Okay. But if the impairment has not happened, what would have been the depreciation every year?
3,000.
Okay. So if the impairment has not happened, the depreciation would have been 3,000 every year. Okay. By the time that the impairment happened, what was the depreciation charge for the 3 years?
2,000.
So what is the difference? What is the difference between the depreciation there?
1,000.
Okay. 1,000 for how many years?
For 3 years.
Okay. That will give us 3,000, isn't it?
Yes, please.
Okay. So the time that the assets were impaired, we are undercharging our depreciation, but we are now assuming that the impairment has not happened. So the depreciation should have been 3,000. So that 3,000 of depreciation will be taken to profit or loss, and that has been taken away from this one. So we have taken the depreciation that should have been charged. So there was undercharge of 3,000. So that 3,000 will be taken to profit or loss. Then the remaining one will be the 5,000. So mostly the reversal of impairment loss will be the impairment loss less the depreciation that was undercharged during the impairment period, because we should have charged a depreciation of 3,000 every year, but we have charged 2,000. It means that we undercharged the depreciation. We undercharged the depreciation. So this can also be done like this. So you can reverse the entire impairment by debiting the assets of 8,000. Okay, by debiting the assets of 8,000, and you credit profit or loss of 8,000. But what you come and do is that there was an undercharge of depreciation of 3,000. So that will be, you debit profit or loss because depreciation is an expense, debit profit or loss of 3,000. Then depreciation reduce the asset, credit the asset of what? Of 3,000. At the end of the day, you are adding
The effect
3,000.
will be the same.
Yes, please. Okay. So that is about the reversal of impairment, whether it is a cash generating unit, whatever. Do the normal entry. The impairment has been done. Carry out the first impairment. Okay. When there is an issue or reversal, just assume that the time that you are going to reverse it, that is the first time that you are going to carry out impairment test. So you calculate the carrying value up to that date. Then you compare with the recoverable amount at that date to know whether the asset has actually impaired or not. Okay. If at this date, this should have been 4,000. If at this date, this should have been if at this date, the recoverable amount should have been 14,000. If at this date, the recoverable amount should have been 14,000. It means that the actual impairment should have been how much? If at this date, the recoverable amount given to us is 14,000, it means that the actual impairment on the asset should have been how much?
1,000.
1,000.
That would have been 1,000, isn't it?
Yes,
Yeah.
please.
Okay. So we are going to be writing the asset at a value of 14,000, isn't it?
Yes, please.
So, but we have 10,000, so we have to come and add the what?
The 4,000.
The 4,000 over here. So what will happen is that you debit your assets. You debit your asset with 4,000. Okay, you credit your P&L with 4,000. Why are we reversing only 4,000? Because the amount that we should have reversed should have been 7,000, because the impairment was only 1,000. But we have undercharged a depreciation of 3,000. So we take it and have the 4,000. So that is how you go about it. Just assume that the time that you are doing the reversal, that is the first time that you are carrying out the impairment test, or the impairment for the first one has not occurred at all. Then you now calculate and know the actual amount that should have been charged as impairment law, or determine whether the asset has impaired or not. Okay, that's how we go about it. If it is cash generating unit, we use the same principle. Just account for how would the transaction be accounted for in the books of the entity. It will be accounted from the time that the asset was purchased up to today. Then if there's a reversal, okay, assuming the impairment has not occurred, what would have been the accounting treatment, and what would have been the carrying value? You compare with what the recoverable amount given to you at that date and know the value that you are going to be carrying. Then you determine how much should be added to the carrying value based on the condition that the asset has impaired from the beginning. That is all. All right. Let's come to the last one. So I just pray that I will do this one before, then I'll just pick a question. Then we see what we can do. Let's come to impairment of corporate assets. Okay, impairment of corporate assets. What do we call a corporate asset? What do we call a corporate asset? Okay, if we have government of Ghana, and the government of Ghana is having a research center that can be accessed by the office of the president, that can accessed by the office of the ministries, and that can be accessed by the office of the district assemblies, we can say that the asset belongs to Ghana as a whole, isn't it?
Yes, please.
Okay, in that case, we don't know whether it is the government that owns the asset, or it is the ministry that owns the asset, or it is the district assemblies. So that particular asset is being called what? A corporate asset. Because we cannot actually apportion, or we cannot actually identify who is the legitimate owner of the asset. So an entity will be having like 3 units, and they will be having a research center. Okay, that particular research center or development center will be used by all the 3 units. Which of the units are you going to be saying that they are going to be the owner of the what? of the research center, we cannot say anything. In that case, that is an asset for the whole organization. So we call it a corporate asset. Sometimes their value can be apportioned based on a reasonable basis when they will be asking you to use their carrying value as a reasonable basis of apportionment. But most times, their corporate assets, we find it difficult to apportion the cost. How do we carry out the impairment test on that particular one? How do we carry out impairment test on that particular one? Okay, let's say you have 3 children. Okay, let's say you have 3 children. Okay, you have 3 children and you have maybe one cousin. So the 4 of them are staying with you. Okay, the 4 of them are staying with you. So you have given them 50 Ghana cedis. Okay, you have given them 50 Ghana cedis to share. But out of these 50 Ghana cedis, what you have done is that you are saying that your first child is Kofi. You are saying that Kofi should take 15 cedis. Okay, then we have Amma. You are saying that Amma should take 13 cedis. Okay, then you are saying that Ajo is the third born. You are saying that Ajo to take 11 cedis. Then you say that they should share. Any amount that is being left should be given to your cousin. How much will be given to your cousin if they have shared this one?
11 cedis.
Are you sure? 15 plus 13 plus 11. What are we having?
39.
Okay, so the remaining balance will be 11 cedis, isn't it?
Yes, please.
Okay, so the same thing applies to the corporate assets. So they will give you value and they will give you value for each of the units. The first thing that you have to do is that you have to ask yourself, how am I going to be sharing? You first of all share to the unit that you are given. Then you come to the money as a whole. So you have given 15 cedis to Kofi, 13 cedis to Amma, Ajo is 11 cedis. Then after that, then you subtract from the total amount. Then the remaining will be given to your cousin. So in the exam, they will give you the recoverable amount of each of the units. Then they will give you recoverable amount of the group as a whole. So you first of all have to carry out the impairment test on the what? On the individual unit, like how we have done this one. We have allocated the money first, then we now total and get the remaining figure that should be given to the cousin. So what we do is that if you want to test for impairment on the corporate assets, okay, the first thing that you have to do is that you test for individual CGUs. So test for impairment on the individual CGUs. Okay, test for impairment on the individual CGUs, which the question will be given to you. Okay, individual CGUs. Okay, including the carrying value of a corporate unit that can be, or a corporate asset that can be apportioned to them, a corporate asset that can be apportioned to them on a reasonable basis, that can be allocated to them on reasonable basis, allocated to them on reasonable basis. So you test for the individual CGUs. So we are now giving this amount. So they will give the recoverable amount of the individual CGUs. So what is the value? Okay, what is the carrying value of the CGU? What is the recoverable amount? You try to see whether that has impaired. Then you put their recoverable amount together now and subtract it from the group as a whole. So after this one, you test for impairments on the group as a whole. Test for impairments for the group as a whole. Okay, for the group as a whole. And the difference over there will be given to the corporate asset, or you also share them based on whatever you are going to be doing. So it's a very simple process. It's a very simple process. There is no big deal. And let's see if we can use one question. Okay, let me also use another example because there can be two situations. Okay, sometimes the question can tell you that, okay, so the question can give you two corporate assets. So they can give you research center. Okay, research center, they can give you 100, and they can also give you, let's say, head office. Okay, they can give you head office to be 150. So they will give you the corporate assets to to be, let's say, 150. Okay. Then the question can say that the research center can be apportioned to the individual CGUs based on their carrying values. So they will give you unit 1. They will give you the unit 1. They will give you their carrying value, or the unit A. They will give you their carrying value to be, let's say, 200 million. Then they will give you their useful life. Let's say the useful life is 5 years. Then they will give you unit 2 or unit B. They can give you 300 million, and they will give the useful life to be 8 years. Then they will give you unit C. They can give you 400 million, and they will give you their useful life to be 10 years. And they are saying that a research center can be apportioned on the basis of what? Their carrying value. Please, which value are you going to be using to apportion the 100? What are the values that you are going to be using to apportion the 100?
Their current values.
If you are doing that, you are being unfair to them, because the 200 over here is for 5 years. This 300 over here is for 8 years. 400 is for 10 years. So you can see that the unit C will be using the what? The asset more than them. So if you are using their carrying value to a share, it is what? It is injustice. Okay. So what we do is that we use what we call the weighted average carrying values, because these people, 400 is for what? It's for 10 years, and this is 200 for 5 years. So the benefit that the person will be enjoying for this particular is going to be more than what? The one that the person is having 200 for 5 years. So we cannot use their carrying value. So what we do is that we use what we call weighted average what? Carrying values. So we try to factor in the useful life. The one with the highest useful life should be having the highest what? Portion of the what? Of the apportionment, because they are going to be using more than the other people. You are going to use this for 10 years. So you're going to use it more than me that are going to use it for 5 years. So I should be having a lower value than you. This person can be having 500 over here, and this person will be having 400. So you'll be saying that this person will be having a higher value than this one. In terms of usage, he will use more than this one. So if you're using the carry value to apportion, you are being unfair to them. So what we do is that we factor in the number of years that you are going to be using. How do we do that? We do 200 multiplied by their useful life, the carrying value multiplied by useful life, 300 multiplied by 8, 400 multiplied by 10. Then we'll be having the 1,000 here. We'll be having 2,400 here. Then we'll be having 4,000. Then we share it now based on their weighted average. We factor in the useful life, because if you are going to use, or if you are going to be there for 10 years, it means that you use it more than me. So you should have what? A higher value. I have a carrying value of 10,000, but I will use that one for only 4 years. But you are having 100, you are going to use more than me. So why will I have more value than you? You are going to enjoy the benefit more than me. So we factor in this particular one. We factor in the useful life. We use the weighted average what? Useful life, which is the carrying value multiplied by the useful life. Then we use this one now to apportion the 100. That is what we do. Okay. But that is what we do. And yeah, for financial reporting people, your level, I don't think, although the corporate asset is part of the 36, but I don't think they can examine you at that level. Even if they will examine you, it will be very simple as compared to the corporate reporting people. Okay, but it's also part of the 36. All right, let's come to the example over here. Then we see what we can do. Okay, question number 33.
Question 33.
All right.
Sycamine PLC has 3 cash generating units, a head office, and research facility. The carrying amount of the asset and their recoverable amount are as follows. So you have unit X, Y, Z, head office, research, and then the total. Their carrying amount and the recoverable amount. The assets of the head office can be reasonably allocated to the 3 units as follows. Unit X, 95 million. Unit Y, 280 million. Unit Z, 375 million. The assets of the research facility cannot be reasonably allocated to the CGUs required, assuming all assets can be justified for impairment. Show how the revised or the adjusted carrying values of the assets of Sycamine PLC should be determined in line with IAS 36 impairment of assets after taking into account any impairment losses in the above scenario. Show the relevant financial statement extracts.
Okay. So we are giving the units, the three cash generating unit, which is the units X, Y, and Z. Then they have the corporate asset, which is the head office, and then the research facility. They are saying that the asset of the head office can be reasonably allocated to the three units as follows. Okay. So this is the carrying, the value over here is the carrying value of the unit X asset alone. And this is unit Y also, this is also one. Okay. But they are saying that the asset of the head office can be reasonably allocated to the three units as follows. So what will be the total carrying value of the asset of unit X? What
That will be 500 plus 95.
So that will be 500 plus what?
95.
95. But what is the recoverable amount given to you?
645.
Has the unit X impaired?
No.
No. Let's count to unit Y. What will be the total carrying value for them?
980.
Okay. What is the value given to you there?
820.
Has the unit Y impaired?
Yes.
Okay. Let's count to unit Z. What will be the total carrying value for them?
1375.
Okay. So what is the recoverable amount?
1355.
Is there any impairment there?
Yes.
Yes. So that is how we do it. So you first of all carry out the impairment test on this one. So you determine the respective what recoverable amount before you go to the group as a whole. Okay. So we are saying that whenever a question like this has been given to you, carry out the impairment loss on each of the assets one by one. So we have the question, we have the Sycamine, PLC. So we determine the carrying value, or let's carry out the impairment test. So impairment test on the CGUs. Okay, the impairment test of the CGUs. So we look for their total carrying value. So we have unit X, unit Y, and unit Z. So let's count to this place. Okay, so we look at the carrying value of their asset itself. Okay, without the carrying value without the corporate asset. What is their carrying value? Without a corporate asset, what is the carrying value of unit X?
500.
That is 500. Okay, that is 500. So we have the 500. Unit Y is what?
700.
700. And unit Z is
1000.
1000. They are saying that the head office can be apportioned to them, isn't it?
Yes, please.
Okay, so they also own part of the head office. So if they own a part of the head office now, what will be the total value of the entity? So you now add the head office to them because the one given to you over there is without a head office. What is their portion of the head office?
95 million for X.
Okay, 95.
280 for Y.
280 and
375 for Z.
okay. So let's look at the total carrying value now. This will be 595.
595, 980,
and 13.
1375.
Okay. Let's now look at the respective recoverable amount given to them.
645,
645,
820,
820,
1355,
1355.
55.
Is there any impairment here?
No, sir.
What will be the impairment here?
160.
160.
Okay. This will be
20.
20.
okay. So how do you think we can share the 160? How are we going to share the 160 to them? For the Y, how would the 160 be shared?
For the Y.
You can say the impairment is relating to the asset of the Y and also the head office, isn't it?
Yes, please.
So how do we
Yeah.
share? How do we share the impairment there? Okay, you have idea about it. We share based on their carrying value, isn't it?
Yeah.
So we have 700 divided by 980 multiplied by what? The 160. Then we have the head office over here. That will be 280 divided by 980 multiplied by 160. What are we having?
The first one is 114.29.
114.29.
0.29.
Okay. So we have 114.29. Okay, the second one will be
45.71.
okay, 45.71. Okay. Let's count to the allocation of this one for Z. So what will be the allocation of that for Z? How do we share the goodwill?
It's also between Z and then the head office.
So 1,000 over 1375 multiplied by 20, isn't it?
Yes, please.
Okay, the head office is what?
375. Sorry. 1355.
Okay, so 1355.
No, the first one is 14.5.
Okay,
55.
14.55. And the last one is what?
5.45.
5.45.
5.45. Okay. So what you have to do is that this is how you share the impairment loss first. Okay. What we have to do now is that we want to see whether they have the head office and research center or which one of them.
Yes, please.
Okay.
Research facility and
Okay.
head
So
office.
we have to know whether the research facility has actually impaired. So what we do now is that the question will always give you the value as a whole. Even if you are not giving the value as a whole, you now compare or you now add all the recoverable amounts now. What is the value? What is the recoverable amount of the entity as a whole, the group as a whole?
2920.
2920.
2820.
Okay. 2920. But you have to know that the group as a whole is made up of all the three CGUs plus the what? The three corporate assets, isn't it? So we have to look at the carrying value of the group as a whole. So what we do is that you start with unit X. Okay, you start with unit X. So let's come to the unit X. Let me be very simple with this one so that we don't have to do plenty. Okay, what is after the impairments? What is the value of the unit X? What will be the carrying value of the unit S in total after the first impairment? What will be the new value now?
595.
Okay, because there's no impairment, so that will be
There was no
595.
impairment.
Okay, so that will be 595. Okay, let's count to unit X. Unit Y rather, total. What is now the what? What is now the value of unit X?
820.
820, because there's an impairment of what? 20. So the 960 has reduced. What will be the value of unit Z?
The lowest.
What is the value?
1355.
Okay. Please don't pick the total carrying value because there was an impairment. So the new value now will be the recoverable amount or the lower of any of them. So it was 1375, but it has impaired by 20. So impairment has been recognized. So it means that the value now is what? 1355. Okay. We can see that we have already included the head office over here. But if we add a research facility to this one, you'll be having the full entity, isn't it?
Yeah.
What is the value of the research facility?
250.
250. Okay.
Yeah,
What
250.
will now be the carrying value of the group as a whole?
30-20.
30 what?
20.
20. But what is the recoverable amount given to you?
The total is 2820. It's
No.
2820.
No, the one given to you, you don't have to add. What is the recoverable amount for the group as a whole?
2920.
29 what?
20.
20. Okay, what are we having? There's a difference of 100, isn't it?
100.
Okay, this 100 is the loss, but this loss, you can have so many assumptions about it. So I'll give you the loss. You can say the loss is actually for the what? For the research facility, because we have already carried out impairment tests on these ones already. So you can say that the loss is for the research facility. Or you can say that, okay, the unit X, the asset of unit X, or the asset of unit Y, and the asset of unit Z, and the head office has also impaired again. Okay, so we can do two things. So this loss, you can just stop here and say the loss is relating to the research facility. Okay, but you can also say that after the first impairment, the X, the Y, the Z together with the head office has further impaired again. You can also say it has further impaired again. So if that is the issue, how do we go about the two? So we are going to be using the two situations. So let's look at the carrying value based on the situation that it has, the 100 is relating to only the research facility. Then unit X, the carrying value after the impairment will be 500 minus what? Minus 0, isn't it? Because there was no impairment there for unit X. So that will be 500. Okay. Let's come to the unit Y. Unit Y assets.
Yeah.
That will be okay. If you count to unit Y, the asset itself will be 700 minus 114.29. So we have 700 minus 114.29. Okay. Then if you count to unit Z, that will be their total carrying value of 1,000. Okay, 1,000 minus the apportionment. We have apportioned this one already. And this is having 14.55. Then you come to the head office. Okay, the head office, the total of the head office will be what? What is the total for the head office? The total carrying value for the head office.
750.
750. Okay. So we have the 750 over here minus the impairment on the two, which is 45.71 and 5.4. So
50.16.
So the two give us 50.16.
Yes, please.
50.16. Then you now bring the research facility here.
250.
250 minus what?
100.
100. Okay, so let's put the values here. 700 minus what?
That's 585.71.
So 585.71. Okay, 1,000 minus the 14.
985.45.
Okay, 985.45. Okay, head office will give us what?
699.84.
699.
0.84.
Okay, so we have 699.84. And this will give us 150, isn't it?
150.
So I'm sure the total will give us maybe the 29,250 if we add it very well.
We are getting 29, 21, but I'm sure it's approximation issue.
Okay, it's approximation. So this is the first, you can assume that all the first asset, they have already been impaired, but the second impairment is entirely relating to the what? The research facility, because we have already impaired the asset of X and then the head office also. But you can also assume that after the first impairment, the asset of the X, the asset of the Y, the asset of the Z, and the head office has further what? Impaired. If that is the case, how do you share the impairments? The impairment will be shared like this. You have the unit, you have the carrying value. The carrying value will now be calculated like this if the asset has further impaired. Okay, what we have now is that the unit X carrying value will now be determined like this. It will be 500 divided by 3020. You can see the total value before the impairment is 3020. Is that correct?
Yes.
Okay.
Yes, please.
Multiply by
100.
the 100. Okay. So let me do 500 first. The 500 first minus that one. So 500 minus 500 over 3020 multiplied by 100. Okay. Unit Y will now be calculated as 585.71 minus 585.71 divided by 3020 multiplied by 100. Unit Z rather will be 985, which is the value after the first impairment, minus 4.5 minus the share of the impairment now. Okay, which will be 3020 multiplied by 100. Okay, let me finish. So you have the head office now. The head office carrying value based on that assumption will be, so head office will be the carrying value after the first impairment, which is 699.84 minus 699.84 divided by 3020 multiplied by the impairment. That will give you the carrying value. And the research facility will be treated as 250 minus 250 over 3020 multiplied by 100. Okay, so if you are using the second assumption, this is the one. Why? Then after the first impairment, the carrying value, so the total carrying value is this one, and these are the carrying values here. So use it to share based on the 3020. I saw a hand up.
Yes, sir. I was just looking at the head office under the current amount on this same screen, the right side. When we have 700 minus 50.16.
Yeah.
I think the 50.16 should have been 51.16.
Oh, really?
Yes, very true.
It should have been 51.16.
Yes.
Yes.
Okay, so 45.71 plus
5.45.
5.45. Okay, so but so it means that this one should be
698.84.
okay, 698.84.
And then that makes it 2020.
So that will be the 2021, isn't it?
Yes, it will be
2921. Okay. So that means that this will be 698. Okay. So 698.84. All right. So that's this basically.
The research, isn't it supposed to be 150?
No,
Minus
that is not 150. The impairment of 100, we assume that is for that one. That is why we are subtracting. But we are saying that the 150, the 100 is relating to all the assets. So it will be shared on the 250. The 150 is coming as a result of, we are saying that the 100 is to this one. We are saying that the 100 is for all the assets. So that will be 250. It will take each share of the 100. So not 150. If you're using 150, it means that you are using a recoverable amount. Okay. Okay. So there's someone, you said I should say something about the 0.94. Okay. Okay. I'm not sure he's there, so maybe I'll just WhatsApp him and then. All right. So this all about this all the things that you're supposed to know about the impairment. This is all the things that you're supposed to know about the impairment. But corporate reporting will be doing impairment of a subsidiary. That will be done when we are doing question solving. So that is all about the impairment of an asset. Any issue, we have 3 minutes more. Any issue? Any issue for more clarification? Any issue for more clarification?
No, sir.
Okay. All right. So if there are no issues, I will see you guys again. But I'll release the questions, the tutorial questions, maybe, so that we can come and solve more questions. So yeah, that is it. I'll see you guys on Monday. Take care of yourself and try your best. Have a good evening. All right.
Thank you, sir.
Thank you.
Good night.